We are from Intercapital, and before we start, I would like to introduce our company first and then ourselves. So we work for Intercapital, the leading non-bank financial institution in Croatia, definitely, but also in the region. Our brokerage department is the biggest one in the country. We also provide investment banking services to our clients, private wealth management, and we are the owners of Genius, fintech app that is basically a robo-advisor for investing. The two of us work for our proprietary trading department. So the main difference between a proprietary trading department and an asset management company is that asset management company works with money from their clients. We are working with money provided to us only by our company. So the investment principles are a bit different. Risk management is a bit different. But in the end, our job is to find profitable trades on the market. My role there is devising strategies that work algorithmically, and besides that, I also do trades on a discretionary basis, meaning that I'm going to be the one who's going to choose when to enter or exit a trade, not just watching what the system will be doing.
So hi, my name is Dominic, and I'm also working at our proprietary trading desk. And as my colleague Emmanuel said, we are trying to find some strategies that are not involved in just discretionary trading. So there are a few types of trading, and one of it is discretionary trading, when a trader, one person, comes and says, okay, I made one analysis of, let's say, gold, and I think it will go up, so I will buy it. So that is not something that we are doing or that we will do. I'm a mathematician, so I'm trying to make some mathematic model that will tell me, okay, something there is mispriced, or there is some good opportunity for me, and I will take advantage of it. So that's one part of it. If you have some models, and then you need to, everything, he comes in and you need to everything program it, see what is happening, backtest it, etc. So today we will talk about futures and options. That's the main part of trading for us, and we will make just one very, very, very small introduction in this topic. So this is a very vast topic, and it involves a lot of mathematics, a lot of programming. So programming today is not part of this lecture. Maybe some very little parts of mathematics will be, and our goal today is just to tell you something about intuition behind these instruments. So when you are talking with traders, rarely someone is trading with those instruments because they have very big background. And at this moment, we will just, our goal is to tell you something about that background so that you are comfortable with it. Okay?
We know that you had a lecture about futures 2 days ago, but nevertheless, we're going to give you a brief overview of futures from our side as well. So a futures contract is basically an agreement between two parties to buy or sell an asset at a certain time that we call an expiry date for a certain price. So those parties that buy and sell futures contracts, they do not trade directly. They are buying and selling those contracts on the exchange, and the clearinghouse stands between them. So that made trading in physical commodities much easier between two parties. A futures curve is a price curve created by gluing together futures contracts by maturity. So for example, Let's take, I don't know, oil, crude oil, for example. You're going to have a contract that matures in 1 month, and its price is going to be 60. You're going to have a contract that matures in 2 months. Its price might be 59 or 61. And when you glue all of the contracts that are traded at one time in the market, you get a futures curve. And the curve can take two distinct shapes that we call contango on the left or backwardation on the right. So what do you think is a normal type of curve? Do you have any idea? No? Okay. The one on the left, which is something like if you would like to buy an asset in 1 year, you're going to have to pay more for it because of the arbitrage principles. But if you sell the asset now, you can deposit the money in the bank, and that amount of money will grow over time, let's say a year, and it should theoretically amount to the future price for a contract that matures in one year.
Okay, so I will just tell you something about the history of futures. Okay, so here it says a standardized agreement, but how do you sell or buy agreement? So one future is like one paper with some information on it. So it has date, expiration date, amount, and price. And it's similar like one bill, 100 euros, let's say. It's just one paper, and it has some value. So what does this mean? I have amount, let's say, 1 ton of wheat. At expiration date, let's say 1 year, 1 ton of wheat, so it would be 1,000 kilograms, and price would be, let's say, 50 euros. So then this piece of paper tells me that in 1 year I can buy 1,000 kilograms of wheat for 50 euros per, let's say, kilogram. And why should I do this? Why should I buy this paper, or why should I sell it? In history, let's say 200 years ago, there were two sides. One would be, let's say, farmer, and the other side would be bakery. And you are trying to remove all the parts of, let's say, weather and stuff like it, because we cannot forecast our revenue, we cannot forecast our anything that depends on our calculations, because we don't know how much are we going to have a wheat as a farmer, or as a bakery we don't know the cost of it, so we need that wheat. So then those two sides came and said, okay, we will have one agreement and we will find a price that is good for both of us in the next year. But something will happen. The price will go up or down. Rarely it will stay the same. And if it goes up, one part of the deal loses money and the other part will gain money. Why? Because for 1 year I can buy wheat for 50 euros, although the current price is 70 euros. But I made that agreement 1 year ago. And also it could happen that the price of wheat goes towards 30 euros, then I will lose money because I have obligation to buy something for 50 euros. But still, both sides have reasoning why they are buying or selling one future. And what happens with that future when the price goes up? Then the price of that future will go up also, because it's not like I have right to buy some wheat for 50 euros, so it's not like I'm going to give it away, because if the current price is 60, then that future is worth 10 at least, okay? And that is one part. What are we trading? We are trading the price of this paper. And so, as Emmanuel said, we have contango. So, future that has expiry for 1 month is here, and that has expiry for 1 year is here. And you have all kind of futures, and if you make a line, we will call it a future line curve. So this is contango, the opposite is backwardation. So there's just a history behind it, because I want you to be comfortable with it, what that agreement is. So when we are talking, it's just like one piece of paper. The second part of the story is, okay, but if I am a farmer, I don't care about the bakery, and vice versa. If I'm a baker, I don't care about the farmer. So I can buy wheat from farmer A or from farmer B. And also, if I'm a farmer, I can sell that wheat to the bakery A or bakery B. So then people realized, okay, I can sell those futures or buy it. And then in, I think, 19th century, eventually they came at the exchange markets and from the commodity parts. And at this moment, that part of the financial market developed, and you have futures pretty much on anything. So from stocks, commodities.
You even have futures on
anything.
weather. You have futures on
CO2,
on bonds. Futures on CO2.
carbon dioxide. That's it.
What's some example for the other curve?
We'll get to that, to backwardation. Yeah, we'll get to that.
So, okay, we'll get to it.
Yeah. So, like Shima said, futures contracts were tailored for physical commodities, but nowadays you've got futures written on anything. I'm just going to backtrack a little. Like Shima said, we mostly trade futures and options. They are a derivative, and okay, back again. They are derivative, and their price depends on the price of their underlying. Like in this example, the price of the futures contract is going to depend on the price of wheat, which is the underlying of that contract. Here on the left, we have price of copper on LME, that's London Metal Exchange, and on CME, that's an exchange in the US. So on the right side is the price difference between them. So they are both settled physically. So after a contract matures, shorts are going to have to deliver copper, and longs are going to receive their copper. So like we can see over here, 1 year ago, there was a huge price difference of around 10%. Copper on CME was 10% more expensive than the one on the London Metal Exchange. Why is that? Because, like Shima said, those are standardized agreements. On the London Metal Exchange, you could deliver Chinese and Russian copper, and you couldn't do that for contracts on CME. So you couldn't buy copper in London and ship it over to States and make a riskless trade. And something similar happened a couple of months ago when Trump introduced his tariffs on copper. The prices of copper in the States went skyrocketed because obviously when you ship copper from the UK to the States, you're going to have to pay import tax. And on the right, there's a price ratio of aluminum on Shanghai exchange and the London one. And again, the price difference comes from shipping costs, the exchange rate, and some other stuff that can happen while you transfer the aluminum from London to Shanghai. So we're going to see an example of a curve that's usually in backwardation, It's a physical commodity, and do you have any idea, like, which one might that be? So you are more willing to pay for that commodity right now and have it stored, like in your warehouse, than receive it in a couple of months.
Oil.
It's oil, yeah. It's basically crude oil. Because if you don't have crude oil on your storage, you can basically shut down the production if you won't have it. And the OPEC Plus cartel that's a cartel of oil exporting countries led by Saudi Arabia. They decide in advance on the amount of oil they will produce, and they usually keep the market in a state of small deficiency. So the curve is usually in backwardation. And here we can see the blue one is basically the current state of the curve, and the purple one and the orange one were states of the curve 6 months ago and 1 month ago.
Okay, so there's a question, why this blue one is so steep on the front part of it? So usually it goes up like one smooth function, but this one is like really steep. Why would it be? So there's something that's connected with physical delivery of it. If there are some consequences that you cannot make the delivery at this moment, then you will see a future curve like it. So if there is a problem, if there is some war or something is happening, some tariffs, etc., then you have a problem right now, but the financial market says, okay, we have a problem, but in 6 months it will be solved, so the price of it for 6 months won't depend on it. So when you have a future curve like it, there is a problem right now on the supply side. And also behind those futures, so we are trading those futures, but we have one more date. It's like first notice, and we need to close that future before that first notice. If you are after that first notice, then you need to make a delivery or take the physical good. So that there is one story behind it. At JP Morgan, there was one junior trader who accidentally, he had like, let's say 100 futures on live cattle,
Yeah, like that.
and he had to sell it before that first notice, and he accidentally bought 100 more. So he pressed wrong button, so JP Morgan received 200 futures worth of live cattle, so he had to go from New York, I think in Chicago, and take those 200 futures of live cattle and sell it or something. So
that's a couple of thousand of live cows that he had to make an arrangement.
There is really a market behind it, and everything in this world works on it. So it's not like there is really a piece of paper and we don't know what it is. It is real oil behind it, live cattle, wheat, etc.
This is also an interesting curve. It is of natural gas, and you can see the seasonality in effect over here. You can see the spikes. This is what, June and December. Yeah, winter you use natural gas for heating, and in the States during summer you're going to use natural gas for generating electricity. So although futures curves usually don't have implications for price in the future, they can incorporate some seasonality effects in them. But they are usually not like predictors of future price. And this is one of corn. So futures curves can really take a lot of interesting shapes.
So those curves are they are moving with time. So you can see on the top, those on the left, that curve on the left was on 23rd of 4th in 6 years ago. So that's why it's on the left, so it was like 6 years ago. Then the white one was 2 years ago.
And the price is on the y-axis. Yeah.
So with time it goes, that future curve. And when we say that you are buying or selling, so you need to, there is one more dimension than you can see here. So it's like whole future curve is moving with time. It's not just that you have one future and that's it. Okay, it has, let's say, 3 months to expiration, but tomorrow it will have 3 months less 1 day. So you need to check also that time, okay, because whole future curve is moving.
Like if you said that you wanted to buy oil, we would ask you, like, which future do you want to buy? The first one, the second one, third one? And like you can see over here, the curves are not, they're not going to be in contango or backwardation for the whole time. The shapes can change. It can be in backwardation now and switch to contango a couple of months later. So an example, let's say you go long, meaning you buy a futures contract with a further expiration date, let's say 1 year, and you sell nearer expiration date, let's say a 2-month one, and after the shorter one expires, you like roll it further. You're gonna buy it back and short another one, like shown over here. Could you find a risk in carrying that position?
So do you understand what is happening behind this? So if we short the one future that's closest to us and we buy some for 1 year, so what will happen in 1 month? So this one, it was like 1 month ago from us, then tomorrow it will be 29 days from us, and it's traveling near the spot price. And it's also happening on this side.
And ceteris paribus?
Yeah, so if everything remains the same and future curve remains the same through the whole 1 month, this future will become this future, and this future will become this future, so it will be like spot price. Spot price is current price. Okay, so we bought this one, and the price on the future curve fell, so we lose on it. But here we shorted one future, and this is the amount that is our gain. Okay, so I don't know if you are familiar with those terms. Short position is if you have -1 future, and if you buy it, so you have +1, it's a long position. So in financial market, you can have minus something of it. You can have, let's say, minus 1,000 kilograms of wheat.
Promise to buy.
Yes. So you have like.
If you short it, you promise to deliver.
To deliver, yeah. So
if you buy, then you're gonna receive it.
So it's like you already lost those 1,000 kilograms, and maybe you don't have it, but you need to have it on delivery day. So what is happening here? You have on a short position, you have this gain, and on a long position, you have this loss. So it's like if we translate those two, so this is plus and this is minus, so our gain is this. Okay, so this is strategy that should work. And the first question is, okay, but we can only short this. Why would we lose something here? But there's one problem, because whole future curve, if the price goes up, what will happen with it? It will go up.
It will translate.
So it will be like here. So if the price of the wheat goes up in those 1 month, whole future will go up. And at that moment, our spot price is not here, it's here. And maybe we didn't make any money. So if it goes up twice of it, comes here, then we lose this money. So this is like a hedge for us. If we are translating the future curve up or down, it won't affect you. But then where is the risk? there is a risk somewhere, because if there is no risk, we will just take all the money that we have and do it all the time, and we will have infinite amount of money very soon. So there must be risk somewhere, and the risk is, as you can see here on, let's say,
The white one.
white line. If you have one supply shock, the first part of the future curve will go up, and this part won't go. It won't follow. So in 15 days, that future curve can look like this. And you are short here, and you lost this, and you are long
This
here, and
probably hasn't moved even.
maybe it's on the same. So 15 days ago, it was like here, future curve. So you can still lose. So this here that I'm trying to draw is that one dimension that we don't see in it. Okay.
Every position that you take in the market has its own risks. Like there are no risk-free trades out there. Like there really aren't any. So after this brief introduction to futures, we can move over to options. Options are also contracts, like Shime is going to explain in a couple of minutes. We distinguish call and put options. They are a right, but not an obligation to buy. So calls are a right to buy, and puts are a right to sell an underlying asset at a certain date for a certain price that is determined by the strike price of the option. They can be written on a multitude of different assets, like stock. They can be written on futures contracts. They can be written on different indices, like equity indices. And we distinguish options by their maturity date and strike.
So the story is pretty much the same. You have one piece of paper with expiration, amount, and price. But on one future, you had obligation. Here you have a right. So if I am a farmer and I sell one call to someone, to the bakery, then he has obligation to buy from me. The right to buy from me on the specific price, let's say 50. So if it goes up, he still has the right to buy for 50 from me. But then what is the gain for me? Because if it goes down, he has a right to buy for 50, and it went down, he won't buy for 50 because on the market he can buy for less. So where's the gain for me? Okay, there is a gain because I'm giving you that right, and you will give me one, what we call one premia. So one amount of money that is fixed and that I will receive for it. And if the price stays the same, I got that amount of money. It's story is pretty much the same as with the insurance of a car. So it's just like one insurance that the price will stay the same, or you have the right to buy something with a specific price, or you have the right to sell something on the specific price.
So down here we have like the basic profiles of P&L on expiration for long call, long put, short call, short put. So when you're long an option, you bought the right, and when you're short an option, you have sold that right to someone else. So if we draw a profile of a long call, this point is going to be the strike price. And basically, after expiration, if this is, let's say, if you bought a call with a strike 50, and the price at expiration is higher than 50, you're obviously going to exercise your right and buy the underlying asset for 50. And you can then immediately sell it on the market for whatever the price is. I don't know, let's say 70. But if the price is lower, 45, then you won't exercise your right, and the option will expire worthless. And the amount that you pay for that right is what Shime said. We call it an option premium.
So just to be sure here, do you understand these graphs? So this is like profit and loss graph. So here, if the price is lower than 50, you are losing money. So 0 should be here somewhere. 0. Okay, so does this make sense? So if the price is coming down, okay, I will just lose that premium that I give it to the farmer, and if it goes up, I will gain. So there is one point, it's a break even. So at this moment, when the price is here, let's say if the premium is 5, so here the price is then 55. So on 55 or on the higher prices, I'm gaining money. So from 50 to 55, I'm still getting some money, but I'm still.
But nevertheless, you're going to exercise the option if the price is higher than 50. You're still going to exercise your option if the price was at expiration, let's say 53, because you're still going to gain those $3 or whatever. So if you're long an option, the maximum amount that you can lose is the premium that you paid for it. But if you are short an option, your risk is unlimited, as we can see on the short call and short put graphs.
Okay, so then there is one more. There's one part of the story that we didn't mention. So those are the, let's say, pricing of one option at the expiration date. But if we bought one option 10 days ago and we have expiration in 3 months, what is the current price of the option? This is a big question, and it was solved in the 70s with the Black-Scholes-Merton model. It's a very, let's say, when you are working on stuff like it, it's like a very easy model. You have one partial differential equation that says if something happens with time, if something happens with something that's called implied volatility, and with risk-free rate and few more parameters, then you can calculate the fair pricing of one option. But how it will look here on this graph? So what will happen? So that's the main story behind options. What is happening with the price of option before expiration? It's easy to see what is happening on expiration, but rarely we leave it to expiration. Mostly we buy or sell one option and close it before expiration. Okay, so I will draw one more graph here. So this should be long call. This is profit and loss, and this is price of underlying. So we bought this option right now. So we still didn't lose any money. So it's not like our current P&L is here, because we can sell it immediately and be with 0. Okay? So then the spot price or the graph of my P&L should be here at this moment. Okay? And what will happen if today price goes up or down? So it's not like I'm here or here, because I will be here in 30 days or on expiration. But today I will not be there. So this is big point. So today's price will go on this line. And this part, this difference, is something that we will call time. That's time of the option. So if it comes down, I still have time for the option, or the underlying price has a time to return on some higher levels, and I will still gain. So it's not like this option here is worthless. And that is not worthless is called time. And this graph here, this line here, with the time will be here, let's say in one more week, and it will come down more and more. So we will have one limit. When time goes to expiration of price of the option, it will be, let's say, this big. So if this line is big P, so the graph of it, okay? And the story about the option are those lines here, not this one. This one is just like bound. I'm bounded below or the above, so I cannot lose more than, let's say, a little bit more. But I'm trading those curves here, okay? And so we are talking about options, so this is one option, okay? And as we mentioned here, you have one future with price on it. But here, I have a lot of options. What does it mean? I can buy one option with this strike, but I can buy one option with some strike here, or with some strike here. It depends on me. So you have not only the expiration and the amount of it, you have also all different strikes of it that you can buy. So if you are buying on the lower price, where the graph should be. So you will still have a line like this one, but it's just, the question is it here or is it here?
The lower one.
Yeah, the lower one, on the call side. On the put side, it will be the opposite. So it will be here. You will have to give more money for it because you are more in the money. Is this correct?
Let's go back a bit. So after this slide, we just wanted to show you how does the option chain look on the market. This is what we see on our Bloomberg terminals and what we watch every day. So here we have options on futures on S&P index. As you can see, here we showed you two different expirations, one in 9 days currently, 20th of June, and the second one in 100 days, 19th of September. And as you can see, we have a multitude of strikes, and each option has its own price. What do bid and ask mean? On option markets, but on the other markets as well, you have market makers. They are market participants that are willing to buy or sell an option from you at any point in time, and they are going to earn on the spread. Something similar would be like a jewelry store. You can buy gold for, you're going to have to pay 100 to buy gold from them, and they're going to give you 95 for the same amount of gold, and they're going to earn on the spread. That's what we can see over here as well.
So those are all those strikes that I mentioned earlier. So you have one strike So what does this mean? So I'm buying right to buy S&P at the price 6650, or I'm buying right to buy S&P at the 6,000, etc. So those are all the rights that someone is giving to me, or that I'm giving to someone else if I'm selling those options. And at this moment, we are talking only with one option. But I think that the S&P should go up. So what will I do? I will buy one call. Okay, so if it goes up, I will be here and I'm gaining money. But what if I'm thinking that S&P should go up, or it will go down, but it won't stay where it is at this moment? Then what can I do? As we mentioned earlier, you have two different types of options. One is call option that looks like this, and the other one is the put option. That looks like this. So here you have a right to buy something, here you have a right to sell something. It's like the same story on the opposite side. And also you can buy right to buy something, but you can sell the right someone else to sell something, then it will be here. The graph will be like this. And also here you can buy right to sell something, or you can sell the right to sell something. Okay, so those are four graphs. So if I'm thinking that the S&P should go down, I will buy one call. And if it's going down, I will make money. If I'm thinking that S&P should go up, I will buy call. Here it's put. So if I'm thinking that S&P will go up or down, but I don't know where, then at the same time I can buy one put and one call. And my P&L graph should look like this. And this here is the premia of call. This here is the term premia of put. If it stays the same, spot is the current price. If it stays the same, let's say those two options are expiring in 1 month, I will lose those two premias. So then I'm here at this moment. So I'm losing this, and here I'm losing this. But what is happening if the S&P goes down? If it goes down, I have limited loss on my call, so I lose whole premium on my call, but put is making money. So if it goes down to the break-even point, for me, I will start gaining money. It's the same story if it goes up. So that is the reason why those options are best way to express your opinion. You cannot do it by with stocks, because you cannot at the same time buy stocks and sell it, because it will cancel out and you will have nothing. And also, if you are thinking, okay, but it will go down, but it won't go down, let's say 50%, then what I can do? I can sell one put that is somewhere here with strike here. So it should look like this. And why should I do that? So if here I sold it, so it should look like this. Then I'm summing those two graphs, and my final graph will be a little bit higher here. So I can do the same on the call side. I can sell one call, we'll say out of the money, and P&L graph will look like this. So if it goes up, I have a limited gain, but I have a little bit smaller loss if it stays on the spot price. And that is the way of thinking that what are we doing and what can we do.
So like we said before, an option value before expiration is made of intrinsic value and time value. And after expiration, only the intrinsic value will remain. And here you can see the relationship that connects put and call prices that have the same strike and time to maturity in formula. And here K is the strike, and it has to be discounted to get the present value. Shime has shown you a profile of a long straddle. But with options, you can create an almost arbitrary strategy of interest. The only risk when you're long an option or an option strategy that doesn't have an unlimited loss on one side is the loss of value over time, or so-called time decay. And the important thing here is selecting options, selecting the time frame where, like your opinion, if you think that the market is going to go up in a month, in 1 month of time, you're not going to buy 1 week options because the move that you have been expecting possibly won't happen before 3 weeks pass, let's say. And
here, as we mentioned earlier, those are profiles on expiration date, but you have some different profiles at today or for 1 day, 1 week, etc. So today it will be something like this. Then in 1 week should be something like this. So those graphs are converging by points and a little bit better than that towards this line.
And you're going to lose your time value as time passes.
So, and do you have intuition behind it why you are losing time value? So if time passes by, at this moment you have like 1 month for the S&P to go to have like a massive drop or a big cycle, something like that. But for 1 week, you don't have 1 month. You have one month minus 1 week. So you have like a less time. So you are saying then, okay, if I have a less time, then it cannot be worth the same as 1 week ago. If you are buying insurance for a car, you cannot expect that insurance for 1 year will be the same as for 1 month.
The probability of an event happening is much less when you have less time for it to happen.
And so you have that time decay. You are losing only by because of the time. And what do you think? How does that graph looks like when you are losing? When the first derivation is the biggest one on that time decay. When you will lose like most of the value of time, is it will it look like linear, or you are losing on the first part of it most, then it slows down, or at first you are losing a little bit, then towards the expiration? So which one of these 3 graphs we can see in options? Sorry? Yeah, the third one. So at this moment, you are losing the smallest amount of money with time decay. Why? Because you still have a lot of time. But when you are coming to expiration, okay, I don't have.
Let's say that you initially had 1 year to expiration, and if a day passes, like who cares? But if you have only 2 days to expiration, then it is when it's going to hurt the most.
Yeah, and so when I'm saying this, it should arise one very, very interesting trade proposal. So it's not linear. Because it's not linear, maybe I can use it on some way. Maybe, just maybe, I can buy one call option that looks like this. So at this moment, I can buy one call option that will expire in 1 year. But maybe then I can sell one option that will expire in 1 week or 1 month. So what then will happen? Because this graph is not linear, it's not like the price. So you have price of 1 year is like 100 euros. And what do you think price of 1 month should be? Is it like 100 divided by 12 or? Smaller or bigger? So you are saying this?
Bigger.
Yeah, bigger. It's strictly bigger. So if I can do this 12 times, I will make money. Why? Because it's just like the insurance of one car. If I'm buying insurance for 1 month, it's not 1/12 of insurance for 1 year. It's a bit bigger. Maybe there is some intuition behind it. There is big mathematics behind it. And at this moment, I won't talk about it. But that 1 month is much bigger than the 1/12 of those 100. So if I do that month after month, so how it will look like then the profile for 1 month? It will look like this. So, but then still, why I'm buying the long call? I'm buying long call because if the price goes up very hard, I won't lose money because that call will protect me. But still, if it stays the same, that call will lose money because of time decay. So I'm trying to gain that money because I'm losing and the S&P is staying the same. So I'm selling those options. I'm selling 1 week or 1 month options. And if I can do that, let's say 5 times or 10 times or 20 times, if I can sell 20 times 1 week option, maybe I can gain the money that big call cost me. And after 20 times, I have call for 0. Do you understand what is happening with this example?
It's flattening out the curve.
Sorry?
Flattening out.
Sorry.
Recovering our losses,
Yeah.
potential losses and selling.
Yeah, because as I mentioned here, you have third graph. So not 1, not 2. So what is happening here? With the long call, I lose only this money, and here for 1 week, it will look like this. So this is my gain and this is my loss. So, and then I'm repeating those trades for a few times, and I'm not doing that, I'm not waiting expiration date, because near the expiration date, I will lose a lot of money on long call. If it stays S&P where it is at this moment, then I will close that long call when I'm here, and then again I will buy one call that is 1 year from me, and then I will repeat the process. This trade is called calendar spread. So you have like 2 legs of it, one on the long part of the curve and one near you. Okay, so I'm just giving you some examples to see how big this subject is and what you can do. So this trade is S&P will go up, but it won't go up in 1 week. Or it will go up, maybe it will go in 1 week, maybe it will not. I don't know. If it goes up in 1 week, I will lose some money on that short call, but I will gain on some long call. And I'm thinking, okay, when it starts, it will go up more and more. Then on the next week, I won't sell. I will just wait for that call. So those are all kind of the strategies that you can do. You can do it by discretionary, when you are just looking at the graph and saying, okay, I think this should go up more or less, then you will trade. Or you can make some algorithmic trading. You can make some models that will calculate, okay, what should you do?
Yeah, but this trade is nevertheless without risk. Like we said before, there are no riskless trades. The options that have longer time to maturity, their value is gonna change is gonna change slower than the one from those that have less time to expiration. So,
Yeah.
if we can show that somehow.
So you are on this curve, and if you take first derivation of it, you will get number like 0.5 on the spot price of the cost of that call.
That's going to be your long call position.
And at this moment, you are losing, if it goes up, you are losing by this graph. And here, the first derivation will also be 0.5. But at this moment, it will be almost 1. Minus. Almost minus 1 here. So you are losing for 10 points, you are losing 10 points. And here, on this big graph, you will have, let's say, 0.6. So you are gaining 0.6. Okay? So it's not like 1 for 1. Then you need to calculate something. Then you need to change this position by time or with the cost of it and all kind of other parameters. So it's not like it's a riskless trade. You have those risks, but still you can manage it. You can still make money if you know how. Those numbers that I just drew are called delta. So those here are delta of options.
Yeah, so basically with Greek letters, we're going to quantify different aspects of risk in an option position. This differential, this is not a differential, this
partial differential
equation shows how a price of an option depends on multiple parameters, and with Greeks we're gonna calculate how price of an option is going to change with respect to a change in a certain parameter. Shime has shown you what a delta is. Delta is going to show the rate of change of the option price in regards to change of the underlying price.
The angle of tangent line of it. So it's delta is one measure that helps us to make amount of our trade, or with delta we know, okay, how much of short calls should we sell, or how much of long calls should we buy, or where is the problem with our trade. So those are all kind of measures. It's a delta, vega, theta that helps us. Okay, what should you at this moment? So it's no big mathematics. It's just like one partial derivation of it. So if you are looking the price of options, okay, by changing of the price of underlying, by change of time, by change of implied volatility. Implied volatility is something that is like how much the market think that one option should cost. So if you go in the market and you can buy one apple for €1, but you can also buy it for €10. It's the same with options, and that measure of pricing is called implied volatility. So if the price of apple is €10, then the implied is very big, and if that apple comes with, I don't know, €0.5, then the implied volatility is very low. If the implied volatility is very low, then market is not expecting any big changes, because then it's not rewarding you. It's not rewarding you if it goes up, and this is very small. It's not something that the market expected. So it's if this cost of this straddle is very small, then the market thinks, okay, the price should be here.
The market thinks that there is a small probability of the price moving outwards of that range.
And then when Trump comes and says, okay, there are tariffs for everyone, then the implied vol jumps So then you have some measures that are measuring implied volatility on S&P. Those measures are called wicks. That is one index that tells us in cumulative how much implied vol there is on the option market for the S&P. And this wicks is, and there are also futures on wicks that you can trade, and those wicks are measuring implied volatility of the options on S&P or the options that are on futures that are on S&P. Then you have futures on that VIX index. Then you have options on that futures on VIX index. So if you are following me, you have implied volatility of an option that is connected with one future of a VIX that is connected with index that is connected with implied volatility of one option that is based on one future of S&P that is based on S&P itself. Yeah.
But in essence, what does the VIX index calculate? The implied volatility of a 30-day S&P option. And we can see here how the market was pricing, let's call it risk or probability that the S&P will move in different points in time. Let's start with the yellow curve. This is a curve from, what is this? More than 6 months ago. So it thought that there was, in general, a low probability of movement in the S&P, but there's a kink over here. This is, let's say, November. Why do you think the market was pricing higher movements during November?
Presidential election.
Yes, yes. So,
And why?
Sorry?
Why?
Because,
So what does this mean? This means, okay, implied volatility on something rocketed. Okay, you have one apple that costs 10 euros. Why?
excuse me,
Why? What is behind it?
the implied volatility or the price?
No. Why do you have like a sharp increase?
Instability.
Yeah, because you don't know, can you buy that apple in 1 week or you cannot buy it. So there is instability in it. So the market simply doesn't know what will happen.
but the
It
market
will
knows
happen.
that there's going to be an event that might lead to that instability.
Yeah. So those events are something that we can see with the VIX. So when the market thinks, okay, something huge will happen, the implied volatility of options will rise massively. So if you don't know, can you buy that apple in 1 week? That apple today will cost 10 euros. If you know that you will have a lot of apples next week, then that apple will cost today like 10 cents. Because I have it now, I have it tomorrow, I have it next week. Okay. And the story, at this moment we are talking only about the options. But there is, I want you to realize that the option is market by itself. So that is, at this moment we are calculating something that's called implied volatility. So those are opinions of market, what will happen with the S&P. But what is the real connection between that implied volatility and the S&P? What is in between? So those options are creating the whole market by its own. So what can happen if you have this situation? You have a wall that is really high, and then what can you do with it? You can buy. So what people thought? People thought, okay, if Trump wins, okay, the S&P is coming to all-time high, we are breaking 7,000, etc. So everyone will buy coal. Everyone is buying coal because coal is something that you should buy if the price should go up. But then everyone is buying coal, then the price of it will rise because everyone is buying. And that rise in prices increase in implied volatility. And then there comes the moment when, okay, this is too expensive. I cannot buy it anymore. It doesn't make any sense. So if you have a coal that costs us, so you are at this moment you are at 5,000, let's say, and you have a coal that costs us 5,000, then S&P should rise to 10,000 to make any money, because here the break-even it will be on 10,000. It doesn't make any sense. Okay, Trump can come, he can win elections, but yeah, S&P won't go up 100%. Then so there is like a cap. There is a moment when the market says, okay, we think that it will go up, but that's too much. And the moment comes and you have a call, but that price of that call is so big that you can barely make any money of it, because the S&P should rise 10% in 1 month, which is just like, maybe it will happen, but probably it will not. Then what can you do? So I just talked about you can buy option, but also you can maybe sell it. So we had like this graph of P&L if we buy, put, and call. So what will happen if we sell it? How this graph will look? It will look the same. Yeah, you just need to rotate it. So it's like this. You are losing money if it goes up. You are losing money if it goes down. But you are gaining if it stays the same. So what is happening when implied volatility goes up? So this was like a few months ago, and today we have elections. So the market thinks something will happen, some huge move, then this will go up to here. The market will reward you with a bigger amount of money, but there is a reason behind it, because everyone thinks, okay, it can go easily down 20-30% and you will be here, or easily can go up 20-30% and you will be here. So it's not like you will have edge in it. At this moment, I'm just talking about implied volatility so that you can have some intuition behind it, because that is one more dimension what is happening on real financial market. So this is something that we see every day, and those movements are really what are we trading, or what are we trying to trade. So those changes in that implied volatility, so you have like a graph that goes with the time, so here, and maybe it can come here, etc. And those are the movements. Those are the real movements, what you are looking for.
Let's look at this graph for 1 more minute. 2 months ago, there was a so-called Liberation Day when Trump came to the podium with his board and showed the numbers of tariffs that he plans to impose on basically everybody in the world. And the market during the subsequent couple of days fell around 20%. And on this pink graph, we can see how the implied volatility skyrocketed, how the market thought that there's going to be a lot of movement in the next 30 days. And let's say that some market participants thought that the pricing was too high. Then you can basically short or sell that implied volatility via the mechanism that Shime explained. And in the next couple of weeks, as we can see on the other curves, market participants also came to that conclusion that the implied volatility was too high, and it fell down. So you could have earned money even though the you didn't exactly trade the price of the underlying, just the implied volatility. Here's an example.
Yeah, so this is something if we buy one put and sell one put at lower strike. So you have like purple line on the expiration date, and those are like red, blue, and the green ones are in between, some dates between from today to expiration date. And what is weird with this P&L graph?
It should be like this.
So this was my trade, I think 1 or 2 years ago, and you can see that weirdness also on this graph. So what is the max loss that I can have? What is the max loss? So it's the lower part of the purple curve. Sorry? How much is it? So, and where is the zero?
Is it below?
So
what's
how
your
much
maximum
can I
loss?
lose? I cannot, yeah. And how is that possible? So if I cannot lose, then I will multiply this by infinity, and I will have infinity money on expiration, and I'm good. So what happened here? So this is something that the option market shouldn't be able to give us. And regularly, you cannot do this ever. Because if you can do this, everyone will do it, and the price will move.
People with much faster computers than us are so-called arbitrageurs, and they are going to take that position much faster than you can if there is a mispricing on the market.
Yeah,
so it's not that.
That is something that you will do on competition, and there are some big companies that are doing that in the real time, on the real markets. You have any mispricing, they will come and buy or sell it, so it will come to the fair price. Okay.
Mispricing in a theoretical sense.
Yeah. So I had a trade that looked like this. This was my initial trade, and I could lose money. I could lose a lot of money for theoretical reason. Let's say I could lose minus infinity. And what happened? The price of the underlying, it was German Bund. Bund is 10-year German bond. It went up. It went up like really hard. So it came to the 133 or 4. I don't remember. So when it comes up, so how did I get this graph, this purple graph? I had one put plus one put at 121. I had minus two put at 130.5. Okay, so you have initial P&L from the long put, and you have two short puts that are like, should be like this, and then one and this one cancel out, and you will have only one down. So that is the purple graph. And what happened? It happened. So it happened that the underlying price went up. And I sold those two puts here. But when the price goes up, what is happening with the lower put? Price falls. Like, why is that? Because what is the long put? Long put is the right that you can buy something at the lower price. If the spot price goes up, and the lower price stays somewhere far, far away from me, I will give a very small amount of money to buy the right to buy something on the lower price. It makes sense.
To sell. The right to sell.
The right to sell, sorry. So that's the reason why the lower put is worth to me like almost nothing. And that happened in this case. The price went, so I was here, the price for 1 week went here. This put are now worth like 1 cent or something like that. And what did I do? I closed one of those puts, so I had one put for 130.5. But it cost me so little that then this graph will come down a little bit. But at this moment, I have one long put, one short put, and the graph will look like this. And that is this graph. Can we go on the next slide? And what happened here? Here happened that I bought one put at 130. So then still I'm losing by 2 puts and gaining for 1 put, so I'm coming down. And then I have one put up and one down, then they cancel each other, and I have this profile. Okay, but the price went up, and I could do that. So that is the reason I couldn't do this at the moment when I opened the trade. So this happened like a few weeks after that I opened the trade.
So option trades aren't static. You have to maintain them through time.
And that is the main goal for you. You have options that you can buy and sell at each time before expiration. And you should use it. And you need to see what are those mispricing during those periods. You cannot just wait expiration. So those are the prices for put prices with the time. So the blue line will show us the puts that are for 1 month, the red one for 2 months, the green one for 3 months. So it will go up. It makes sense because you have more time for it, as we mentioned earlier. And if the price goes, so that happened here, when the price, if you are far, far away from the lower parts, they are like less expensive than the ones that are near you. Okay? And it's the same with the call side, it's just you can rotate it.
Here we have an example of an economic calendar from a year ago. We left it here on purpose. We know it's a bit outdated, but it was a week really packed with data that left market impact. So every day, it's usually thought that markets are almost efficient. Like, have you heard about the efficient market hypothesis? It stipulates that at any point in time, the price is where it should be. Let's put it that way. But as new data points and new information and scientific discoveries come, the price is supposed to move to another one somewhere else. And when we receive data points like US GDP, US inflation, inflation in Germany, the unemployment rate in Germany, those are the data points that are going to most definitely impact the market. And here we can see how it happened in real time and across multiple markets. So this was probably 25th of April in 2024. We received US GDP print that came lower than it was expected, and American bond markets and American equity markets, forex markets, they all had a reaction at the same time.
Yeah, so everything starts to fall like instantaneously. So on this graph here is S&P and DAX. You can see in German DAX, nothing happened because you are in Germany and this is US data. On the upper part is euro dollar. Here is gold and silver. They didn't care. This is oil, and on the last you have US 2-year, US 10-year, German 2-year, German 10-year. But here you have a reaction US, in Germany, because those two markets are really connected. You have like safe haven instruments, and those are primarily German bonds. So Germany is like top safe haven in the world. So it's like the best benchmark for bond market anywhere. But still, US has a really big bond market, and if something happens in US that is not definitely safe haven, but near safe haven, if it happens in US, it will reflect on Germany also.
Yeah, so although the data point was connected with the US, we had some spillovers over in the Europe as well, and other world markets as well.
And so those are, this is a German 10-year paper, German 10-year bond that is called Bund. And you have this spike, initial spike that goes up, then it goes very hard down. Those movements are trades that were made like milliseconds away from the official data release. And you have a lot of algorithmic trading near those release dates. So when I say a lot, it's like billions and billions of dollars that are bought or sold at that moment, and then they are rushing, and every millisecond counts. So everyone who is, so they are building all those places near stock markets, exchange markets, so that the data needs to travel only a few hundred meters and not few.
They want to minimize the latency.
Kilometers. So everything is in it so that you will be the fastest one.
Something like that might be also important for you in your trading competition.
But also, usually there is like this first, let's say, slippage when the price goes in the wrong direction. Then the trades see, okay, I did it wrong. Then I need to go in the opposite direction, and they are just moving the whole market with that algorithmic trading.
And
there is one more thing that I mentioned earlier. Options are market by itself. So options are involved in the S&P price. If S&P goes up, calls should gain money, puts should lose money, and that is correct. But at this moment, option market is so big market, it's at this moment bigger than the primary market. So if you have S&P and all the trades that were made on S&P, and if you look in option market is bigger. So what is the story behind it? It is because there are some big players, primarily market makers. Market makers are the companies that gives you bid and ask that we saw earlier. So when you are buying a call, he has a position that is like this. So if the market goes hardly up, a market maker will lose money, and he don't want to lose money. So he will buy S&P. He will buy S&P, and on the other hand, he will have profile like this. Okay? Because he bought some S&P. If S&P goes up, he will gain with those stocks that he bought. But still, he has a risk on this side, so he needs something that is long put, etc. So he has like millions and millions, maybe billions of options that are opened, and he has a whole future market and the stocks to buy and sell to be what we call delta neutral. When he's delta neutral, so delta is 0, and we said that delta is S&P changes, market maker won't gain or won't lose money, and he will gain only on bid-ask spread. But because he's constantly buying and selling S&P, and he's doing that in so big lots that market maker can move whole market by its own, because the option market is bigger than the whole market around the S&P. So at this moment, you have S&P that affects option market because intrinsic value, it is what it is. But also you have, in the reverse, option market is so big and market makers are so big that they are affecting whole S&P. Then you have some specific things that can happen, like a gamma squeeze. That is that the market maker has to buy S&P, but he's, we'll say, gamma positive. So it means that this delta is 0 at this moment at this price, but delta will be, let's say, 0.1 if it goes a little bit up. So then he needs to buy a little bit more S&P. But because he bought more S&P, he's still giving fuel for S&P to rise. Then, but he bought it, so his delta will be again 0. But because he bought it, he put it up, he gave power for S&P to go up, then he need to buy it one more time. But then his delta is again 0.0, but when the regime is that he's gamma positive, let's just go with the flow that we know what gamma is and etc. But you can maybe feel it. So his gamma will rise more and more than on the first part. So he, at every moment, he needs to buy more and more S&P. More and more S&P, and the price goes up and up with a bigger magnitude, and he's making a squeeze. That is something that you won't see on S&P because S&P is still pretty big, but you can see it on some specific stocks like GameStop, probably you heard for it. And those are the moments when the price goes like from 10 to 100 in one morning. So it's connected with option market, not only with the that stock or fundamentals around it, etc. So those two things are, you should consider it as two different financial markets that are that have some real strong connections. Okay, so those are just like fun facts. You don't need to know anything about it.
Before the Q&A session, we're going to end with a short real-world example of a hedge. And one interesting question. Do you know what hacienda means in Spanish? Do you know hacienda in Vodice? Also, in Spanish it means like a house or something. But hacienda de la Tresor is like a Ministerstvo Financija or the Treasury Department of Mexico. And before that, I'm just quickly going to explain what a hedge is. So besides taking speculative positions in options and futures, you can use them for hedging. A hedge, it is basically a strategy of risk management in which we take an opposite position in a correlated asset. So we are giving up some of the potential profit in exchange for lower or capped risk. For example, Starbucks has coffee as their raw coffee beans as their inputs, and they're going to lose money if the price of their inputs rises. So to hedge their exposure, they can take a long position in coffee futures, or they can buy calls as well, or some similar structures via options. And also, coffee producers, if they think that the price is high and that it might fall, they might also hedge their exposure via shorting futures or buying puts or something similar. So, hacienda hedge. Mexico holds the 10th place in the world in terms of total volume of oil produced, and the share of revenue for the government from oil exports amounts to 15% of the total revenue of the country. So you can imagine why they would want to know what the price of the oil they're going to sell is going to be, so they can balance the budget. And they are too big to do it on the open market, so they usually contact big banks like Barclays, Goldman Sachs, Morgan Stanley, Deutsche Bank to give them a quote, and each year they renew their hedges. So in 2008, 2009, when the oil price spiked over 110, 120 briefly. They wanted to hedge their exposure to oil price because they don't have the oil on them right now. They're going to produce it in a couple of months, and they want to sell it at the current market price that was in 4 months' time, probably around 100, let's say. And the way they did it, they contacted those large banks and basically bought call options from them. And on that specific year, it paid out greatly because oil prices fell below 50, and I think they had strikes around 80. So they earned a lot of money on those options that they bought. And this is it from us. And do you have any questions?
How often do you develop new strategies?
How often do we develop new strategies? You mean discretionary trades or like algorithmic systematically? Discretionary. Like discretionary means that you follow the market and then as a mispricing occurs, then you use it to your advantage. So it's more dependent on the mispricings on the market than yourself developing new strategies. But I would say that it takes some time to completely understand a market that you're trading in. I don't know, it's like learning a skill. It takes a couple of months to really understand what are the drivers of a certain market, and when you understand them completely, then you know when a certain mispricing has occurred. So I don't know, I think that the exact number you are asking is around 3 to 6 months for a certain asset, a certain market. Anybody else?
About the German bonds you were talking about, so that was obviously like a misprice in the market, right?
Which one? The strategy?
The German bonds,
His strategy.
Yeah.
So how do you mean it was a misprice?
What was it a misprice? I'm
No,
asking.
no, because
The options were bought and sold at different points in time.
Okay.
that's the reason. Because can we go on the next? Next. So this is initial trade, and then for 1 week, something happened in that week. Then I had the opportunity to make adjustments.
He basically had an opportunity to hedge his downside risk,
Yeah.
but still having a trade that can't lose money on expiration.
And how often does that happen? Is it like 1 in 10 years?
No. This happens. This is initial trade. So there is, you have like 2 options, 2 possibilities. It's a better word. The price can go up or down. If it goes up for any amount of money, then you can hedge on the lower price, and you can have something similar with it. So it will happen like 50% of time, but if it goes down, you will lose money. So it's not like the best, this is not the best thinking of the matter, but it's similar with it.
How do you choose which market to invest in?
How we are not investors. We are That's I didn't like specify it on the beginning of our presentation. Like our time frames are much shorter than the ones from asset managers. They're gonna think what's gonna happen with a certain market in 6 years' time, in 1 year time, in 2 year time. We are thinking more short term, like what's gonna happen with the price of a certain asset in a week, in 2 weeks, in 3 weeks. I would say that our average holding period for a strategy is 2 to 3 weeks, something like that. So
with the prop trading, you can trade pretty much anything that has a market that is liquid. So we don't have any regulation, we don't have any laws that are affecting us, so we can trade really anything that has market.
Yeah, but you are
So that has
following
bid and ask.
everything that's happening in the world, and you're trying to think what's going to happen to price of a certain asset. Like we trade, like literally everything, but through options and futures. So from commodities, equities, equity indices, single stocks, FX.
Do you go for more like volatile markets or
Yeah,
stable?
yeah, yeah.
More,
Volatile.
yeah.
So because volatility is what we trade, or to be precise, change in volatility, change in implied volatility is what are we trading?
Usually, when a market is volatile, that's when most of the mispricings are going to occur, rather than when markets are stable and nothing is happening.
So if you trade the change in volatility, do you buy, do you sell the options? What's the time frame? Like one month before the news, or I suppose you trade the news? Yes.
Sometimes,
Or some instruments.
but we are trading every day, intraday, intra-week. So there are days when you don't have news. So it's not like it's a constant job, and you need to find some things that are affecting market, and you think that it shouldn't be there. It's just like a game of like you are using law of big numbers. So something will happen for 1,000 times, and there is something that will happen 10 times, and if it's happening, if the market is pricing that those events that will happen 10 in 1,000, then we will go on the opposite part of it. It's just like playing cards. Or
It's like we know that an event is going to happen, and let's take NVIDIA earnings for an example. Via options, we calculated that the market is expecting that the release of earnings from NVIDIA is going to move the market 20% on average. And we're going to say, that the number is too big or too low, and take an adequate position for our way of thinking.
And how do you calculate the number that you think is going to change?
That's where mathematical models and programming come into play.
we can talk about it, but we will need like 2 years.
Yeah.
So we are out of space at this moment, but there are ways to calculate it. So that one equation that you could solve earlier, called Black-Scholes, that is the first equation that explained, okay, the fair pricing, or what it should be fair pricing of one option. And then there are some different models. And when I say model, I mean you have one partial differential equation. So when you calculate what that partial differential equation tells you, you should know the price of one option. If the price is different, then you are assuming something is happening. So you need to have like whole model. So you need to have your own partial differential equation that will tell you, okay, with your model, this should be at this moment, and it's not. So those are like models that you are calculating are those partial differential equations.
So you create your own models.
Yeah. So, and it's like pretty big, like, it's not only about trading, it's about science, because you have a lot of mathematics behind it, and pretty much everything that you see around you has some mathematical model in it. If you are looking car, or a plane, or a building, or a bridge, or anything, someone took some mathematical equation and calculate, okay, this should happen if there is a wind, if there is all kind of stuff. So we are trying to do similar with the financial market. So that equation took only few parameters like risk-free rate, like implied volatility. Okay, implied volatility has a different connection with it, but let's say that they took implied volatility and risk-free rate and time, and that's it. But maybe I can make model that where I can use those 3 parameters, and maybe I can use, I don't know, price of gold, because I have a strong bias that gold will affect that market, because I made some backtesting that showed me in average that will happen. So I have my own model that has 1 more parameter or 10 more parameters, and everyone else is not looking in it, because it's not, it is market and it is almost efficient, but it's not. Something can happen, and the part of market needs to realize that it happened, and you have time to do something, and that time to do something is the place where you can make money. Okay, so everyone has some of its own metrics, and big parts of those equations are that you have retail investors, so like ordinary people in US, and you have millions of them that are betting. They are literally betting, and you can exploit those rise in implied vol or falls, and that's one part. And the other part is that you have like pension funds and some hedge funds and some other funds that still have some laws that they need to follow. So if you have someone that has a law, then he is predictable. You know what he will do if this happens to market, and you don't need to do it because you are not obligated by that law. So you can use that knowledge that someone else will not do what is rational, because he will do what he has to do, because the law told him to do that. So all those parameters we are using. Yeah. Any more questions?
If not, thank you all for coming, and good luck in your competition.
Thank you.